Dividends, let's talk about it. How can you guys pretty much live off of just your money, infinitely making you more money in retrospect? Let's talk about it. Dividends decoded, the path of income. So the quest for passive income. Let's define financial freedom. So income without labor. So passive income, and I know you guys have heard of it. What is passive income in the first place? Passive income is money earned regularly with little to no ongoing effort. This is distinct from actively trading stocks or working a job. Dividend investing focuses on making your money work for you. So the challenge of inflation. Inflation erodes purchasing power, and a successful passive income strategy must aim to generate income that not only covers living expenses, but also grows fast enough to outpace rising costs over the long term. So why do dividends matter within the first place? So they give you reliable cash flow. Dividends are regular payments that are paid and made by companies to their shareholders, and they can provide predictable cash flow, which is crucial whether you're reinvesting or funding the current expenses. And let's talk about the compounding effect. When you use dividend payments to just buy more shares of the dividend, the next payment will be even larger, inshallah. And this is the magic of compounding, exponentially accelerating your portfolio growth over decades. So for example, imagine receiving a $100 dividend payment. If you spend it, the growth stops. But if you use it to buy more shares, let's say a dividend costs $50 a share, a dividend ETF, right? Let's say hypothetically, for example, you invested into StackMODE ETF, right? Let's say it existed. For example, okay, StackMODE ETF costs $50 and you make $100 on the payout. You could buy 2 more shares of StackMODE ETF because it costs $50 a share and you got $100 from the payout. Okay. So stack it up, stay in StackMODE, stay down. Keeps it fun, keeps it fresh. So the corporate distribution of profits. So definition and source. A dividend is essentially a distribution of portion of a company's earning, decided by its board of directors and paid out to its shareholders, and it reflects the profitability and financial stability of the underlying company. So let's talk about the dividend yield. The yield is the annual dividend payment divided by the current stock price, expressed as a percentage. It is a key critical metric for income investors, showing the return on investment purely from the dividend income. So the payment frequency. So in the US, most companies pay dividends quarterly, right? Let's say for 4 times a year. However, some firms pay monthly, which provides smoother income, and others pay annually, okay? So if you're getting paid monthly dividends, then you could budget out your bills, for example, based off that income. Some dividends only pay annually once a year, and some dividends pay quarterly, okay? So every couple months. So the dividend safety. The most important factor is the company's ability to sustain and grow the payout. Investors often examine the payout ratio, dividends paid by dividend earnings, to ensure the payment is covered by current profits and is not at risk of being cut. So a high yield is going to be attractive, right? But a growing upwards dividend is generally better than a high but stagnant one. And companies with long track records of increasing dividends are often referred to as dividend aristocrats or dividend kings. Okay, so you want to be playing a dividend that's increasing in size. More people are investing into it year after year, and it's making good, consistent investments, and it has a good bundle of stocks within the ETF. So key dates and dividend types, let's talk about them. So 4 crucial dates: the declaration date. So the day the company's board announces dividend payment, specifying the amount, record date, and the payment date. And we'll talk about the ex-dividend date. This is the most critical day. To receive the dividend, you must own the stock before the market opens on this date. And on this day, the stock typically drops by the amount of the dividend. And the record date. The company list of shareholders eligible to receive the dividend is finalized. And this is generally 2 business days after the ex-dividend date. And the payment date. It's the day the dividend is actually credited to your brokerage account, so you can actually go spend it, withdraw it, and put it in your bank account. And types of payouts. Cash dividends. The most common type. This is a direct cash payment deposited in your account, either in US dollars or the local currency. And stock dividends. The company pays shareholders in additional shares of stock rather than cash, and this increases the number of shares you own, but reduces the per share value. I want to talk about special dividends. So one-time non-recurring payment. usually much larger than a regular dividend, often resulting from a major cash windfall, a sad sale, or extraordinary profits. So for key distinction, the ex-dividend date is what truly matters for investors in the long run. If you buy on or after this date, you miss the current payment. If you sell on or after this date, you'll still receive the payment, for example. So let's deconstruct the exchange traded fund. Okay, once again, ETF stands for exchange traded fund. So class, it's an instant diversification tool. It pretty much gives you a basket of assets. So an ETF has a collection or a basket of dozens, hundreds, or even thousands of individual stocks, bonds, or other assets. When you buy one share of an ETF, you gain ownership in tiny pieces of all the underlying assets. And it trades just like a stock. So unlike traditional mutual funds, ETFs trade on stock exchanges throughout the day, just like an individual stock. This gives them greater liquidity and pricing transparency, and the low cost and transparent, and the expense ratio. So ETFs are generally low cost vehicles. The expense ratio is the annual fee charged by the fund, expressed as a percentage of your total investment. The lower, the better for long-term returns. And passive management. Most ETFs are passively managed, meaning that they simply track an index like the S&P 500, for example, or Bitcoin. Some ETFs track cryptocurrency as well too, and these keep management costs low comparatively to actively managed funds, which try to beat the market. So there's going to be crypto ETFs, tech ETFs, ETFs that focus on power companies, etc., and a focus on diversification. The greatest benefit of ETFs is diversification. If one stock in the fund performs poorly, the impact of your overall investment is minimal because it's balanced by hundreds of other holdings. And this significantly reduces risk. It doesn't always have to be hundreds, it could be however amount the ETFs has in their basket. So the powerful synergy, right? Dividends plus ETFs, crazy. So check it. Safety in numbers. So mitigating payout risk. If you invest in a single high dividend stock, and the company cuts its dividend, your income stream is severely damaged. And a dividend ETF holds dozens of these companies. So if one cuts its payout, the overall effect of the ETF's dividend income is negligible. And reduced volatility. So dividend paying companies are often more established and financially stable, leading to less volatile stock prices compared to high growth, non-dividend stocks. Combining these steady stocks into an ETF smooths out the ride even more. And we'll talk about the ease of income generation. So simplify management. To create a diversified dividend portfolio manually, you would need to buy 50 to 100 individual stocks and manage all their dates and tax paperwork. Okay, so that's how you would have to do it normally. And ETF pretty much does it all for you, simplifying the investment process immensely. So it gives you a nice monthly income stream, especially once you have enough money invested into it. And each ETF pays out a different dividend amount. Do your research before you invest. So many dividend ETFs are structured to pay out monthly rather than quarterly, providing a more consistent and easier to budget income flow for those relying on the payments in order to live off the what's called passive income. But a lot of the times you have to do something active to get the passive income. Okay, so it's like you get to retire by making the right decisions, inshallah, if God wills. So think of an ETF as a pre-made high quality soup. Instead of spending hours buying and preparing 50 different ingredients and hoping the recipe works, you buy the ready-made dividend soup with proven ingredients and a consistent flavor. Okay, so making it a lot simpler. So accelerating growth, dividend reinvestment plans. So automating the compound process. What is DRIP? Okay, a DRIP automatically takes the cash dividend you receive and uses it to purchase more shares or fractional shares of the same ETF. This happens automatically, removing the need for a manual intervention. So long-term wealth accumulation. Then reinvestment phase is critical during your accumulation years. And by automatically buying more shares, you are increasing your share count, which means the next dividend payment will be significantly larger than it would have been otherwise. And the power of fractional shares. Most brokerages allow ETFs to be bought in fractional shares through a DRIP. And this ensures that every penny of the dividend is put back to work immediately, maximizing compound from day one. The transition to income. When you enter retirement and need the income, you simply turn the DRIP feature off, and the dividends will then be paid out to you as cash, providing a regular passive income stream. So here's a crucial tax note. All right. So even if you reinvest the dividend using a DRIP, the IRS considers that dividend income to be income that you receive. You must still pay taxes on it the year it was paid, unless the investment is held within a tax advantaged account like a Roth IRA or 401k, which also have limited amounts that you can put into it per year. So keep that in mind. So dividend ETF categories, tools of the trade. So let's talk about dividend growth ETFs. So the focus of them. The companies with long history of increasing their dividends, and the goal of them is to increase the total return and have an inflation-proof thing that people can invest into safely. And the benefit of them, you sacrifice high current yield for faster dividend growth, protecting future purchasing power. For example, funds tracking companies that have raised dividends for 10 or more consecutive years. And high yield ETFs, they're stocks with the highest current dividend yield and the maximum immediate cash flow involved with them is going to be super duper heavy compared to the other ones. And they have a higher yield, which often means higher risk, and these companies may be in declining industries or struggling financially. And these funds are concentrated in real estate investment trusts or certain utility sectors. Now let's talk about the sector-specific ETFs. It's concentrated exposure to sectors known for high payouts, and it's targeted income and diversification within a specific sector. And it reduces broad diversification, yields higher returns, but has a higher risk specific to that entry. Okay, so if you're in a crypto ETF, for example, okay, and crypto's in a downtrend and a bear market, you would go ahead and face that. Okay, but that's just how trading works in general. So for example, you're gonna have utility ETFs, consumer staples ETFs, financial sector ETFs, crypto ETFs, etc. So figure out what you want to invest in. So building your income portfolio, let's talk about it. So one, some step-by-step implementation. So identify your goal. What do you guys want to do? How much do you want to make? And what do you want to do in the first place? Okay, determine how much annual income you require for retirement. How much do you need to pay your bills? How much is your rent or mortgage, right? How much is your internet, your car, etc. Okay, and use the 4% rule or similar withdrawal strategy to estimate the portfolio size needed. So select the ETFs that collectively provide a realistic, sustainable dividend yield, typically between 2% and 5%, and avoid extreme yields unless you fully understand the underlying risk and what you're investing in. And automate contributions. Set up automatic monthly contributions from your bank account to your brokerage account. Okay, if you want to do automatic, or you guys can do manual, up to you. Just put yourself on a consistent schedule. Keep putting money away and get into stack mode. So consistency is the most important factor in long-term success. And activate the drip if you can. And ensures that all dividends are automatically reinvested to harness the power of compounding until the day you need to rely on the income. So a portfolio example, right? Some hypothetical allocation. Okay. So let's say 50% core dividend ETFs. You could do 30% a high yield dividend ETF, and then 20% like a global real estate ETF or crypto ETF. And that's just for example. Do your own research, but that's just how someone would break down the portfolio. So your job is only to contribute regularly, get into stack mode, wake up, pray to God, stay humble, put the money away, don't look at it, hide your balance even, okay? You can actually put your balance on all dots, hide your balance, just deposit, keep stacking, okay? Stay down and live off a minimal amount, okay? Make it fun, make it hard, make it challenging, okay? And periodically rebalance the portfolio to maintain your desired allocation. And the ETFs manage hundreds of underlying stocks for you, or depending how many the ETF holds. And some tax implications, right? Let's talk about where to hold your assets. Taxable accounts, right? Brokerage accounts. So qualified dividends. These are taxed at a preferential long-term capital gains rate, which is 0%, 50%, or 20%, which are typically lower than ordinary tax and income rates. And non-qualified dividends. These are taxed as ordinary income at your current marginal tax rate. This includes most dividends from real estate investment trusts, REITs, and foreign companies. So we'll talk about some tax advantage accounts though. Roth and 401ks, okay? They can be ideal for dividends, but keep in mind that Roth and 401ks are going to be limited. So Roth IRAs, as of when this video is going to be recorded, is going to have around a 7K limit per year that you can invest in, okay? And then when you're 50 years old, plus, then you could do 8K a year, okay? And then you're going to have the 401k. And 401k, you're going to be able to invest, I think it's around like 23,500 if I'm not mistaken, and then it increases to like 31,000 once you're 50. Let me know in the comments below, but pretty sure that's it if I'm not mistaken. But some traditional accounts, tax deferred. So dividends grow, right? Tax deferred. It's where you pay no tax on them until you withdraw the funds in retirement, at which the entire withdrawal is taxed as earned income. Keep in mind, these numbers could change, and this is just as of 2025 when this video is being recorded. So, strategic placement. It's highly recommended to hold your highest yielding non-qualified dividend ETFs like REIT's funds inside your Roth accounts to shield the highly taxed income from the IRS forever. So, conclusion, the dividend blueprint, right? So the combination of dividend income and exchange traded funds creates a powerful, simplified, and resilient passive income engine. So you can diversify. Use dividend ETFs to gain exposure to hundreds of dividend paying companies instantly, mitigating the risk of a single company cutting its payout. And reinvest, right? Harness compounding by activating dividend reinvestment plans, also known as DRIPs. Okay, not talking about clothes. Until you guys are ready to transition from the accumulation phase to the income phase. And optimize your taxes. Prioritize saving for retirement with a Roth account, as all dividend income and growth within it will remain permanently tax-free. So the combination of dividend income and exchange traded funds creates a powerful, simplified, and resilient passive income engine. Decide what you want to invest in, do your research, and if you need some help deciding what you want to invest in, you can head over to StackMODE.net. Stay prayed up to God, keep grinding, and I'll catch you guys in the next one. Peace.